Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, April 4, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And it was a pretty impressive reversal day today in the markets. We gapped lower about 40 some odd points in the S&P, and the market immediately turned around, and as you can see here on the chart, finished near the highs of the day. This is a pretty good and impressive reversal. We're still inside this bearish pattern, albeit hard to believe after a day like today. Nothing has really changed in the big scheme of things. However, it wouldn't be out of the ordinary from this point based on today's price action. So we gap lower, the market reverses, you get everybody in the boat on one side, get them on the long side. We had some personally, I think we had certain traders buying short into the market today, got whipsawed out and had some short covering, and then the short covering is forced buying, it's panic buying, and then buying begets buying. All the markets reversed. When we take a look at the IWM, even the transports were down big at the open. They reversed. The broker-dealers, everything had a reversal. A rising tide lifts all boats. So what we have to pay attention to is two things. On the bullish side, we have to recognize that there's probably some short-term, at least, upside in this market. Namely, and I used to have this line at 266.50. Today I moved it up to 266.75, not that far away. Really what I'm trying to say is that the high of this candle from the 27th, which comes in at 266.77, I just rounded it to 266 3/4, that high is going to be resistance to the market. If we should get above that, there's right close above that, there are very good resistance points, some overhead resistance. Three reasons why. You have a downsloping 20-period moving average. You have the 100-period moving average sloping across. Comes in around the same area as this pivot top, which comes in at 268.87. So if I look at this, after 266.75, the next major area of resistance is right here. A lot of overhead resistance. The market would have a very difficult time just waltzing through that area. So basically what we have is a down move. We still have a bearish wedge pattern any way you want to look at it. Even if the market goes higher, as long as we stay underneath this general zone, just call it underneath the moving averages, this is still a bona fide bearish wedge pattern. And if we got above the moving averages, that would turn the market short-term bullish. But there's a lot of work to do and a lot of points in between where we are and where these moving averages are. And in order for us to close above these moving averages, that's a tremendous move in the market. You're basically talking about another 80 or so S&P handles to get above that general zone and keep going. That's a tall order. Not saying it can't happen. I just suspect that we're going to first have a pretty decent amount of resistance right up at this red line. Now, you're going to hear all kinds of things in the media today. You're going to hear market reversal. You're going to hear it was a bottom or the bottom was made and we're going to go up from here. And while that all may be true, let me point something else out as I think was one of the big reasons why we saw the market reverse today. So when you look at the weekly chart, today was the first day in a very long time, all the way since July of 2016, where we actually hit the 50-period or 50-week moving average. I think that's an important development. So I think what's happening here is because we hit the 50-week moving average, I think you had a lot of computerized buy programs. The market may have been drawn down to that area, and then we had a lot of buying at that area, predetermined buying in and around that 50-period moving average, figuring the market was going to bounce. You came up just short of the double bottom from the 9th of February, which comes in at 252.92. The low today was 254.67. On a weekly chart, that's not all that much. It's about 20 or 25 S&P handles away. It's not all that much, but we did hit the 50-week moving average. But here's what I'll say, and this is something that any trader that's taken my course at Lazy E Mini Trader would be attuned to. Is the 50-period moving average as strong as a support area as it once was or would have been had we hit it on the 9th of February all the way back here? And the answer is no, and I'm going to explain why. But before I do, let me just make mention again, I love the comments that you folks are making on the videos. Keep it up. Keep making comments. I love having the interaction about what you all are thinking about the markets. I like having the back and forth. I think it's healthy for everybody. We can actually learn some added material because you never know who's going to ask what question. A lot of them are very, very good. A lot of the comments are very, very good. And then I give my point of view, and that's what makes a market. What makes a market is different traders, different investors, different analysts have different points of view, have different ways to look at the market, have different ways to read the market, read the tape, and that's what makes a market because we can both look at the same chart and one of us could see something bullish and the other one can see something bearish, and that's what makes a market. That's what makes price discovery. So keep the comments coming, keep the likes coming, share the videos if you think this can be beneficial to somebody you know who's maybe struggling with the market or wants to make some money in the market. There's certainly things that everybody can learn and take away from these videos. So let's get back to the 50-week moving average. So the way I look at it is, if we hit the 50-week moving average on the 9th of February, we would have had we did have a tremendous rally, even coming up short off that level or just north of that level. So I would have expected the same type of bounce or rally off the 50-period moving average that we did get anyway when we came up short. We had some front runners of the 50-period moving average at the time. Then we had a nice big rally and we've come back down. So we had a near miss. We had a nice big rally. The market took a huge deep breath. And then we came back down and we came up short once again a couple of weeks ago of the 50-period moving average. Then we had a rally off that level or just north of that level where back to the 266.50, 266.60, 75 area. We'll just call this a general area, okay? We don't have to get precise to the penny. It's a general resistance point. You can go up to 267 and it can come up short at 266.50. Either way, it's a general zone. This week, we hit the 50-period moving average. I think there's a lot of market participants that are convinced that's a big deal, a bigger deal at this stage than I think it is, mainly because we've basically come close a couple of times, rallied away from it, have come back down. So the way I look at it, we've basically consolidated over and above the 50-week moving average in a bearish wedge formation, okay? And that still tells me, as long as this pattern is active, it still tells me there's another potential leg coming to the downside. And just so that everybody's aware, is it possible the downside, at least for now, for example, for the next few weeks, is it possible that downside is finished? Of course it's possible. Anything is possible. And therein lies another important factoid about the markets and about trading and investing in the markets. You have to be willing to adjust or change your opinion based on what's happening today in the markets, based on what might happen tomorrow in the markets. Okay? So what we don't want to do is we don't want to force our hand on the market. We don't want to be stubborn in the market. The market is right 100% of the time. It's analysts, traders, investors that are wrong if we're wrong at all. One thing that I make mention of in these videos quite frequently is when we have a bear phase in the market, a downtrend like we're in now, and keep in mind, we're still below the 50, 20, and 100 period moving averages, below the important red line, we'll call it, which is a resistance line. We've just had another healthy bounce off this level, off these lows that have made here. Now, it may be a reversal day and we may go up for a while and it may not. The point is that you have to be willing to adjust your opinion. Intraday, I was able to adjust my opinion of the markets as soon as I started seeing the type of reversal that was at hand, and there is some money to be made when you can spot a reversal intraday, in this case on the long side. The IWM quickly reversed, wasn't down that much even as the spider was trading lower, wasn't absolutely getting killed. The transports were down large today, but then they started to reverse. The broker-dealers were down big today, and they started to reverse. one market at a time, one after the other, started to reverse trend and started to trend higher. And when you see that boat shifting, and sometimes it's like an aircraft carrier, and sometimes it's like a very small vessel that can turn very quickly, when you can spot these turns coming, you can spot the turns that have already happened, you can certainly take advantage of them on a day like today on the long side. And here's a 10-minute chart. Let me explain a couple of things that any trader that's been in my course understands fully. There were at least 2 trades, even if you came to the party late. So what do we have here? This is where the market opened today. So what we had was, we had a bottom put in early, and then the market started trending higher. And at this point, you're not 100% sure exactly what's going to happen. You have a gap fill over here. Maybe the market's going to react off that, which it did, very slight. It did a little bit. There was a small trade in there. But then what happened was we started going sideways. As we start going sideways, you have to believe that there's more upside, but you have a double top from yesterday. What happened at the double top? The market put in a signal of a trend change. In addition to putting in a signal of a trend change, the market also trended up from the first candle of the day, about 20 candles. Now that's one short of a very important number. In my course, I go over some important numbers, and I go over in detail why that's important. But when you see a trend change and the market's gone up for a certain period of time, or at least very, very close to an almost perfect period of time, and you're into a double top, the stars start to line up, and you have to say, after a run like this, the market's due for a pullback, and we know where we're wrong. And what I mean by that is, if in fact somebody was interested to short the market right here, okay, signal of a trend change into a double top, market goes up for a specific period of time, you know that you're wrong on in this case, it's a 10-minute chart, so we're looking for a 10-minute candle close above the high of this candle here, and that would have been the reason to say, I've got to cover the trade, I'm wrong, the market's going to continue higher. Well, it did pull back, it gave us a nice pullback, and therefore gave an opportunity to traders that wanted to play the short side based on those facts, a nice profit on the downside. Then what happened? So that was trade number 1 if you were paying attention. Trade number 2 was when we closed above this double top area on the second run. Because what did this become? It became an A, B, C pattern. Okay, and that's exactly what happened. The A leg was up. We ran into a double top. We had a signal of a trend change. The market pulled back in the B leg. We found some support. No definitive reason why the support was there. Not necessarily going to say we all knew the support was going to be there. That's not the case. Market put in a little bit of a doji candle. Maybe that was the reason. Maybe it was because we were into the moving averages. But either way, as we started to go back up, once we closed above the high of the earlier candle at 1250 right here, that was another signal, right? Even if you came to the party late, that was a signal that the market is headed higher under normal conditions. That's just the way it is. Maybe you get a back test, which we never really got in full, of that double top area, right? The double top from here. Maybe we get a back test. That would have been an ideal buying opportunity. But this is definitely an indication that the market is going higher. You saw all the markets reverse. The IWM kept getting stronger. The transports, even though they finished down, we'll get to that in a minute, kept getting stronger after being down over 200 points. So when you start to see that, you have to believe that the momentum is going to carry the market higher mainly into the end of the day unless something quirky happens, which it didn't. So this is exactly what happened. So there was trade number 2 if you're paying attention, and that's if you're to the party late. That's if you weren't buying down here, which you may or may not have a reason to, but I'm just suggesting that based on a double top and a pullback and then a breach of the old highs, your ABC pattern, that was the second trade. Those were 2 very identifiable trades that happened throughout the day today. That's not even including certain stocks that were, making certain patterns, reaching certain areas. That's not including any equity trades that may have been available today. This is just based on the SPY, which also applies to the S&P 500 E-mini futures contract. Same chart, same pattern, same routine. Now we'll look at the IWM. Nice big strong up day, finishing up after being down, up 1.32%. That's a nice reversal day. You can see here that we came close, or at least attempted, to get up to the 100 period moving average. Again, just like the spider, this is the general area where you're going to find a lot of resistance somewhere in this zone right here with the IWM, because you have overhead resistance in terms of moving averages sloping down. You have an important pivot top right here. That was the high from the 23rd of March. Okay, you also have another breakdown candle high right here from the 27th of March. You have moving averages in the same general area. So there will be formidable resistance in this zone. Could we certainly go higher into tomorrow, get some follow through? Absolutely. If the market goes higher into tomorrow and we get some follow through, my expectation, same with the spider, but also on the IWM, that we would get a price reaction in the downward direction from this general zone if we got up into that 153.5 to 154 zone in the IWM. It's a nice big move from where we are now, and if that happened, I would think we would get a nice price pullback from that general area. Transportation average. While we still finished down 6 points today, it was a nice reversal in the transports. We were down quite a bit earlier in the day, had a nice rally back, but when you look from a visual perspective at this chart, do you see anything different than you saw yesterday? We have a down move, we have basically a bear flag pattern, a consolidation pattern, bearish wedge pattern, any way you want to look at it, anything you want to call it is fine with me. Has anything changed from yesterday? You can go back to the video from yesterday. I probably drew the same exact thing. This is a very tight bear flag pattern or bearish consolidation pattern. All we had today and yesterday was an up day, but we have not yet been able to get above, and if we do, that will change things. But we haven't yet been able to get above these moving averages. Where this market will change, where it will turn up, where the daily chart will actually begin to turn bullish, is a close above 10,612.86, which happens to be right in this area here, which is the top of the breakdown candle. If we got above that, we would have also gotten above the moving averages. That will turn the transports on the daily chart back to a short-term bullish stance. Until and unless that happens, nothing has really changed from a visual perspective of the pattern that's developing on the chart in the transports. NASDAQ market, or the Qs. Big update today. Nice big reversal day, no doubt about it. Can't take anything away from the Qs today. Up 1.78%. A very large up day after being down early in the morning. Again, from a visual perspective, from a longer term perspective, we're still in a downtrend, but we can have some more upside. We can come up to this 100 period moving average. We can come up to this pivot top or this pivot high at 161.71. There's still going to be a lot of resistance in that zone, but there's nothing to say the market over the next day or so can't get up to that area. The market will not turn, at least from a short-term perspective, bullish until we get above 165.5, above these moving averages, above this breakdown candle high. Until and unless that happens, this market is still going to have downward pressure against it. In these type of environments, when we turn from bullish to bearish, when the market's in a downtrend, you tend to get these big swings in both directions. I've said that before many, many times. Today was one of those swings. You're always going to have up days. You're going to have up days strung together, 2, 3, 4 in a row. Then you're going to have big down days, also strung together, 2, 3, 4 in a row. That's the way it works in these type of environments. So what I'm trying to say is, while the market may turn bullish, we may rally from here for weeks. It absolutely may happen. I'm just suggesting from a technical perspective, nothing has changed from the longer term outlook. Until and unless it does, the market is just having a reflective bounce higher after threatening the downside today. Again, remember back to the spider chart, hitting for the first time in a long time the 50-week moving average. I think that had something to do with the reflective bounce higher that we did get today intraday. We'll see how long it holds, but definitely an impressive rally nonetheless. Broker dealers, big up today, $2.73, up almost 1% after being down earlier in the day, over $2 or $2.50 in the broker-dealer index. But guess what? This is the same thing that we just looked at in the transports. You have the down move, and nothing has really changed in terms of this range here that makes up the bearish consolidation or bear flag pattern. This will generally play out in the downside direction. So while we did have a nice big up day, we have not broken the range that takes this pattern off the table. That's the bear case. If we go higher and we get above the high of this breakdown candle, 292.88, that definitely changes the bear case. Until and unless that happens, this market is still susceptible to another down move. I did get a request to go over Bitcoin, so I will do it quickly. I'm not going to give a lot of commentary on Bitcoin. It is somewhat reminiscent of the bubbles that we've had in the past. For example, about 10 years ago, we had the credit bubble. About 18 years ago, we had the .com bubble, where anything with the name .com after its name was getting a huge rally in the market. The market was melting up. You could do no wrong. And then the market crashed from those highs because the bubble popped in terms of it's called the .com bubble. Then we had in 2007 into 2008, we had the credit bubble, also known as the real estate bust. You could buy a house, sell it a few weeks later for a nice healthy profit. You could just sign your name, get any amount of money you wanted. That's a credit bubble. It created a real estate bubble. We all know what happened there. It crashed. The next bubble on the docket was the cryptocurrency bubble, the Bitcoin bubble. We were going up, up, up each and every day. Nobody could lose any money. Everybody had to buy Bitcoin. Everybody had to buy Ethereum, Litecoin, any coin they wanted. And it would go up, up, up. We went all the way up just short of 20,000 when everybody was telling you that it's going to 100,000. We're going to convert currency over to Bitcoin. Everybody's going to accept Bitcoin. Countries are going to make Bitcoin their standard. I heard it all at that point in time. And then what happened? The bubble burst. We had a big move down. We put in a bearish consolidation pattern, as you can see here. Here, I'll just even draw it out. I mean, we look at these patterns all the time. We had the down move. You had a reflective rally. We put in a bearish wedge pattern. The market made another down move. We had a reactionary rally again, and now we're melting down again. This should result in one more move down, to my opinion, potentially as low as about $5,000 before we get any kind of a substantial rally in Bitcoin. That's the way I see it. When you look at the weekly chart, and there's not a ton of history here, so it's not that easy to read when you don't have that much history. But what do I always say? I always say markets like to come back and test former breakout and former breakdown areas. There's a very specific price level on this chart where this market broke out to the upside. Those that have taken the course know where this is. And if I'm right and the market wants to come back and test the former breakout area, it's going to be below 5,000. Do I think that will create a buying opportunity? I do think that will create a buying opportunity. I don't know when it will happen. It may happen in 2 weeks. It may happen in 6 weeks. Either way, I do think the market will achieve under 5,000 before we get a substantial rally. And that will be precisely the time when nobody wants to hear about Bitcoin ever again. And that's just the way markets work over and over and over again. When everybody can't get enough of it, you're generally closer to a top. When nobody wants to hear about it, you can start looking for an area that makes sense to where a bottom, or at least temporary bottom, may be. Gold, no change to the outlook in gold. We had a spike higher. We finish, or maybe finish, it's not closed yet today, but might finish near the lows today. Again, it's very erratic. There's no clarity on this chart. We're just going to move it along. I showed the weekly chart last night. The weekly chart is bullish. This chart is going back and forth. It looks more like an EKG on the daily chart than anything else, and it's very difficult to trade gold back and forth, back and forth, back and forth. If you're a long-term holder and you're looking at the weekly chart looks like higher prices are coming. That would come into question if we start getting closes below 1,300. That would put downward pressure in the price of gold. Until and unless that happens, from a long-term perspective, it still looks bullish to me. Going over to crude oil, look where we went today. So crude oil was getting hit earlier in the day with the market, and where we went to was making a low today of 62.06. We talked about 62.13. That's the green horizontal line running across the screen. That also is just above this trend line that we drew in a couple of days ago. So you can see how the market respected the 62.13. Crude oil respected 62.13. There's a very specific reason why. I discussed it in previous videos. Again, it's taught in detail and the reasons why in the course at Lazy E Mini Trader. This is no joke, folks. All markets act and react the same way. All charts act and react the same way. Doesn't matter whether you're looking at a 10-minute chart, an hourly chart, daily, weekly, or monthly, they all act and react the same way. You can certainly take something away from this information. This information is actionable. It works the majority of the time. Nothing works 100% of the time. But if you have the probabilities in your favor, based on the fact that something works the majority of the time, and you buy correctly, meaning if you were willing to buy the market with limited risk, the crude oil market, at the low of this green candle, 62.13, in that general area, if you were willing to buy it with a reasonable risk, that was a good risk reward because you were very and extremely likely to get a bounce higher off that level. Even if it was only intraday, even if it was just temporary, that was at minimum of a tradable opportunity. And with that, folks, it's everything I wanted to and intended to discuss tonight, so I will give it a wrap here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.